Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Michael Pento of Pento Portfolio Strategies. Thank you for joining us again, Michael.
Thank you for having me, Jason.
Thanks, Michael. And you made a great call about that the Ben Bernanke would stick with the QE when people thought he might delay it.
Well, thank you very much for saying so. It's not hard to read someone's mind who studied the Great Depression and is trying to avoid 1937 and 1929 with all his efforts. So he's going to keep printing money until the unemployment rate declines. The unemployment rate is not going to decline unless everybody leaves the workforce. So we're going to have money printing, about $40 billion now and about $85 billion starting in January. Unsterilized quantitative easing as far as the eye can see.
Do you think this means that the U.S. and world economy then is stuck in permanent stagflation?
Yes, I do. I think, well, nothing's permanent, but I think for as far as the eye can see, until central bankers repent and ask for forgiveness of their sins, their monetary transgressions, I think, yes, we are stuck in a world of stagflation, which could lead to intractable inflation.
Yeah, so what are the factors then? Because I think eventually there is going to be that inflationary expectations increase that velocity of money. What are the types of factors then you think that could move us from a lower level of stagflation to that von Mises crack-a-boom scenario?
Well, first of all, you need a transmission mechanism. So the Fed prints money, they buy bank assets, mortgage-backed securities, and treasuries primarily, and then the commercial banks, private banks have a Fed credit. Now, what they do with that credit is very important, because if they don't do anything with that credit, you won't have a money multiplier effect, and you won't have hyper or intractable inflation. You'll just have stagflation. So what I predict is going to happen is we're going to keep running trillion-dollar deficits here in the United States as far as the eye can see, so the money supply is going to grow by at least $1 trillion each and every year. That's a significant increase in M2 and in M3. And over the course of time, I think those deficits grow larger and larger. They'll be monetized by the central bank using commercial banks as a conduit. You'll get a huge increase in the money supply. You'll see a falling off of goods and services available for purchase. You'll get rapidly rising prices and ever-increasing condition of inflation.
Do you think the stock market is moving on fundamentals at all anymore?
No.
Or is it?
No. Well, it's obviously not moving on fundamentals. It's not moving on the unemployment condition in the United States. It's not moving on corporate earnings. They're basically flat. It's not moving on revenue, which is down year over year. It's not moving on any fundamentals that I could see. We're basically stagnating as a country. If you used a real inflation metric, GDP would be negative. We'd be in recession. The only thing the averages are moving on, which as I predicted would happen, is a nominal move higher, because when you create $40 billion every month, and commercial banks are expanding the money supply as measured by M2 by 7%, the money's got to go somewhere. Well, where's it going to go? Is it going to go in a bank account and earn nothing? Probably not. Is it going to go in a U.S. 10-year Treasury earning 1.6%? Probably not, unless you're the Federal Reserve. So where does it go? It goes into stocks, and primarily it's going to end up in precious metals, energy, agriculture.
Very good. Do you think there's anything to stop the Fed from perpetually expanding its balance sheet and continuing to monetize Treasury debt and other toxic assets and continually giving Wall Street more free money to speculate with?
Well, yeah. I mean, if Mitt Romney was to get elected and he followed through on his threat to get rid of Ben Bernanke, and you brought somebody in like Paul Volcker, and he dramatically raised interest rates, and then you had a balanced budget amendment passed by Congress, we would see a dramatic deflationary depression. It would purge all the excesses out of the economy, and we'd wipe out a tremendous amount of money supply, asset prices, and then we'd start all over again with a much sounder economy. I don't think that's politically tenable. I don't think Mitt Romney would stand idly by and watch that happen. I think it's what should happen, but he's a politician, and as soon as we have a crisis like 2008, he'll do exactly the same thing that George W. did and Barack Obama did.
Yeah, the lobbyists, the lobbyists and the special interests, like I live right outside of D.C., there's no way they would let that happen. So even if one of the political parties loses some power, the lobbyists and the special interest groups still control most of the political capital and a lot of money.
What I like to say, Jason, is that the Republicans and Democrats are opposite sides of the same butt crack. So, they're very, very similar. There's no real difference between the two. It's just minor nuances. And if we do have a condition, which I predict will happen again, when interest rates start to rise because of the huge increase in debt issuance or because of the increase in money supply, eventually inflation or supply will overwhelm the bond market. Interest rates starts to rise, and I think it's going to be met by more and more intervention on the part of Ben Bernanke. If the economy does start to collapse because interest rates rise, what do you think President hopeful Mitt Romney would do? He certainly wouldn't cut spending dramatically, and he certainly would probably replace the replacement for Ben Bernanke with someone who mimicked Ben Bernanke, because the last thing you can have as a political leader is a deflationary depression. That's what everybody wants to avoid. Again, that's what we need to occur. We deserve it. We've earned it. It's the only cathartic mechanism that'll let this country start all over again with lower levels of debt, lower level of asset prices, and lower level of money supply. But that's exactly what's not going to be allowed to occur. So unfortunately, I think when we do have another condition like 2008, the fall of 2008 occur, you'll see the exact same tactics taken towards fighting that depression.
Exactly, and we need free market forces. We need the market to set the interest rate. Mm-hmm. So in this situation, people would be rewarded for starting to save and rebuild their base and producing more than they consume and start rebuilding their savings that way, instead of being subprime credit card borrowers or students with student loans and spending money they don't have.
Well, what you said there is monumentally important. I've been writing about this and speaking about it for years. Why did we ever let a small group of individuals that sit on the Federal Open Market Committee decide the most important price mechanism in the country? And that is the level of interest rates or the cost of money. We cannot allow that to be manipulated any longer. We cannot allow quantitative easing 1, 2, 3, and as a matter of fact, Charles Evans, who was the president of the Chicago Fed, hinted at and laid out the plan for QE4. Now, you have QE3 right now, which is $40 billion in mortgage-backed securities purchases outright. Then you have $45 billion of Operation Twist, which is supposed to end in January, which is the buying of longer-term treasuries and selling paper from the government that's maturing in less than 3 years. Now, Evans said, and this has kind of gone unnoticed by the media, but I wrote about it, Evans said that when Operation Twist ends, we're going to have QE4, which is $45 billion of purchases of MBS and treasuries. That's not going to be sterilized. A continuation of Operation Twist, which, by the way, cannot be sterilized because the Fed's balance sheet doesn't have any more short-term paper. They have zero bills and about $150 billion left, or $175 billion left of notes that mature in less than 3 years. So you cannot sterilize $580 billion over the course of a year when you only have $175 billion of short-term paper. So this is going to be an unsterilized, double-down version of QE3.
So for our listeners who are not familiar with some of the central banker speak with sterilized and unsterilized, does the sterilized term mean that all that money, that $540 billion you talked about, that money is going to go into the stock market, or that money is going to be lent out, or okay, what do you think is going to happen to that money?
So Operation Twist is basically a twist on the interest rate curve. So they're buying long-term paper, selling short-term paper. It does not increase the size of the Fed's balance sheet at $45 billion. The $40 billion of mortgage-backed securities absolutely does increase the size of the Fed's balance sheet, which is part of the monetary base, which is monetary base, meaning that's how all money is created, through the fractional reserve system. So the monetary base is increasing. If QE4 goes into effect as Charles Evans, the architect of QE3, has indicated, if he gets his way and QE4 takes effect, we'll have $85 billion of mortgage-backed securities and treasury bond purchases from the Fed, increasing the size of the Fed's balance sheet that will not be sterilized.
That's really good for gold and silver.
Jason, every month. Unlimited duration of $85 billion a month. And that's why you see, you just can't knock down gold and oil. I mean, what are you going to do when you really understand that the Federal Reserve is destroying the purchasing power of your currency? They are manipulating interest rates lower forever. What are you going to do? Are you going to put your money in the bank and earn nothing? Are you going to buy a one-year T-bill that's earning next to nothing? Or are you going to put your money in an asset that has thousands of years of a tradition in protecting your purchasing power? All you want to do now is keep up with inflation, because you never will by buying. You're guaranteed to lose money by holding cash. Its currency is losing purchasing power not only against hard assets but against overseas currencies that are not going down this rat hole. But I'll tell you one thing else. If you want to see and witness the depreciation of the U.S. dollar, do not look at the renminbi, which is pegged to the dollar. Do not look at the euro. Now, let's just go into those things really quickly. The People's Bank of China injected $58 billion into money markets last week. That's an all-time record. The ECB under Mario Draghi said that he will do whatever it takes, quote unquote, whatever it takes, to monetize European debt and prevent interest rates from rising. He has usurped control of the entire bond market. He is the only buyer of Spanish, Italian, Greek, Portuguese, and Irish debt. So these are unprecedented and coordinated moves by developed nation central banks. Never before has occurred. So don't look for the dollar to drop against the euro. Don't look for it to drop against the renminbi or against the pound. Look for it to drop against gold, which I think will set an all-time nominal high early next year.
Do you think, Michael, that the miners will also benefit from the gold price rising? Because for the last 12 months, It's been very painful for the gold mining stocks.
They're down significantly. I think they're down like 30, GDXJ is down like 30, 40% over the last 12 months. Well, what's important is that what I do is I model the difference between inflation and deflation. There are cyclical periods of deflation when the central bank steps aside from debt monetization, and you have the resumption of what naturally would occur, which is a deflationary depression. If we had no government, if the government wasn't manipulating interest rates lower right now, interest rates would skyrocket in the short term. We would have a deleveraging process. Too much debt is held by the corporation. Too much debt is held by the government. You'd have a selling of assets, a paying down debt, and a reduction in the money supply. That's what naturally, it's a gravitational force. It's what naturally wants to occur. Now, what is fighting that is the central bank increasing its balance sheet, commercial banks using that money to purchase government debt, and that's how the money supply is growing. Any interruption in that process causes the gravitational force to come to the fore. So that's why you just can't buy and hold gold stocks. I don't do that here at my at Pento Portfolio Strategies. I'm buying gold stocks primarily when the Fed's balance sheet is increasing, and I'm selling them when it's not. And if you can play that swing, you'll do much better, infinitely better than just buying a basket of GDX or GDXJ or GLD or Sprott, PHYS. If you just buy them and hold, you're doing yourself a huge disservice. You have to model the behavior of government and act accordingly. However, having said that, now that we're in this reflationary phase, a rapid increase in the size of the balance sheet, I think gold stocks not only catch up to the metals move, but surpass it. And that will be the story for 2013. The only caveat being, of course, if Romney is elected and he followed through on his threat to fire Ben Bernanke, then you don't know what you're going to get in the short term. So that's why it pays not to go to sleep with your portfolio.
Very good. Michael, please tell our listeners more about your website and your work and where they can follow you.
Okay, so it's mpento@pentaport.com. My email is mpento@pentaport.com. www.pentaport.com is the website. You could find on my website my performance data for my fund, a little bit more about how we invest. And we have an office in New Jersey. We have an office in Massachusetts. You can call me here at 732-203-1333.
Thank you, and hopefully we'll have you back on soon.
Okay, thank you, Jason.